Hey everybody, Rob Maurer here, and today we are going to be going through the proposed legislation that we had mentioned last night. We now finally have the details on what this new bill is shaping up to look like. Still can be changes, but we'll go through how the current structure looks. There are potentially huge EV tax credits in here and a lot of components to understand, and there are massive implications for Tesla Energy, both solar and energy storage as well. Before we get into that though, the busy week in the market continues. Tesla today up 2.2%, closing at $842.70, outperforming the NASDAQ up 1.1%. Both were trading red this morning at some points, of course, after the first advanced estimate for Q2 GDP was published. Now again, this is not the final estimate, that'll come in a couple months, but the first estimate here from the US Bureau of Economic Analysis is that GDP declined at an annual rate of 0.9% in the second quarter. So possibly 2 consecutive quarters of declining GDP. We have talked before about whether or not that's a recession. Technically, that gets defined by the National Bureau of Economic Research. It's been that way for a long time, though recently seems to have become a political hot button, so whatever, don't really care about that. The political aspect, that is, but with a recession, I'm not sure exactly how important it is, such a binary term. I think obviously the underlying elements are much more important. So GDP wasn't down as far as it was in Q1. And a lot of people also noting that decreases in private inventory investment drove GDP down in the second quarter, but still saw increases in personal consumption expenditures, or PCE. At any rate, we'll get a revised estimate for GDP in about a month and then the final estimate in about 2 months, but the market's taking that in stride so far. And then after market close, of course, we had big earnings from Amazon and Apple. Both seem to beat expectations. I think the media, again, having trouble figuring out where Amazon really came in because of Rivian adjustments, but they did beat on the top line, gave pretty good guidance. And then Apple beat on both the bottom and top lines. And they did say that they were impacted less by part shortages for the quarter than what they had guided for in April. So that should be taken as pretty good news for the market more broadly. So quite a few good earnings reports this week, guidance in many cases being held, in some cases even coming in a little bit higher than what was expected. So there seems to be progress being made, and some of the supply crunches that we have been seeing for the last year may be starting to look like there's a bit of an end in sight. All right, let's move on to the EV tax credit. Spent a lot of time on this, far too much time on this today, I would say, but really just wanted to put all these pieces together because I've seen a lot of confusion, a lot of inaccurate reporting. It's understandable. This stuff is very confusing to work through. Let me just show you an example from part of this new bill, which is, by the way, called the Inflation Reduction Act of 2022. Gotta love branding in politics. Sure, this bill puts billions of dollars into the economy, but all right, inflation reduction. Anyway, how things like this are written is that they build on previous legislation. So for example, just to see how confusing this stuff can be, here's a snippet from a change for pre-owned vehicles. It says, in general, subpart A of part 4 of subchapter A of chapter 1 is amended by inserting after section 25D the following new section. Like, what is that supposed to mean? Nobody knows unless you go back to that previous legislation and you actually kind of piece these things together. So for this, that's what I have done. This took way too long, but now we've got a really clean look at what has been proposed to be changed, what has been proposed to be added, and how all those different references to different sections all come together. So we're obviously not going to go through this line by line, but I will highlight and piece together the important parts. We will start at the top because everything kind of builds on what preceded it. So you can see a big section there struck out. That is how the current credit, or what would be the old credit if this does pass, calculated the amount of EV tax credit. So it started at $2,500 and it built from there $417 for every kilowatt hour a battery had past 5 kilowatt hours. All that's gone, so we've got a clean slate for how the credit would be calculated. It's got 2 new criteria. Each grants a credit of $3,750, so $7,500 in total if both are met. Those criteria are based on critical minerals and battery components. Of course, that doesn't tell us anything yet, so we have to reference another section that has also just been added, and that is section E. Yeah, big long boring wall of text that we can see there, but we can simplify that and say that basically some percent of the value of the minerals in the battery must be sourced from free trade agreement countries. All right, so minerals here, we're talking nickel, lithium, iron, manganese, etc. And to start off in 2023, 40% of those minerals would have to be sourced from free trade countries. That scales up 10% per year, getting up to 80% in 2027. If those thresholds are met, that earns a $3,750 credit. If not, 0 credit. You can see the free trade agreement countries there. Obviously, China not on the list. Another notable one, Indonesia, not on the list. So this might be a little bit tricky for manufacturers to earn. We'll have to do a little bit more research on that. All right, so that's the first half of the credit. The second half is for battery components. Again, we'll have text here, but we can simplify this by saying that basically some percent of the value of the battery components, not minerals, the battery components, must be manufactured or assembled in North America. So that has to be 50% of the components in 2023, 60% in 2024 and 25, and then 10% more per year, getting up to 100% in 2029. Again, if those thresholds are met, you get all of that portion of the credit. If they're not met, none of that portion of the credit. We'll come back to how that might fit for Tesla later on, but first let's make sure that any of these credits can even apply to Tesla in the first place, because there is this whole list of things that need to be done to be a so-called qualified new clean vehicle. So about half this list, pretty boilerplate, carried over from previous legislation. One of the first changes we see on here is that to qualify, a vehicle has to have a battery capacity not less than 7 kilowatt hours. Previously that read 4. So to me, that is bad news in terms of how this bill is structured. That means plug-in hybrid vehicles very much still eligible, even for the full $7,500 credit. In fact, in some cases, a plug-in hybrid under the structure, again, this is just a proposal, could change. Under the structure, a plug-in hybrid could actually earn more of a credit than under the previous legislation. Previously, a plug-in hybrid with a 7 kilowatt hour battery, that could have earned a maximum of a $3,300 credit. That same vehicle in the structure would earn a $7,500 credit, more than double. That's for a 7 kilowatt hour battery. That's probably going to cost a manufacturer about $700 for that battery, maybe worst case, about $1,000. That's an extremely heavy incentive that's going to push the manufacturing of plug-in hybrids, which we don't need to get into that whole thing now, but in my view, just a very, very inefficient choice and something that is a crutch and possibly works very strongly against transitioning to fully electric vehicles. So very disappointed with that part of the structure. Very unsurprising though. Can almost guarantee that legacy automakers are heavily lobbying for that so that they can keep producing internal combustion engine vehicles. We see this in this legislation. We see it in emissions legislation. It's extremely disappointing. Make plug-in hybrids if you want, but don't credit that at the same amount of a full electric vehicle. So that's some of the bad news. The other new qualification that they added in here is that the vehicle's final assembly must be done in North America. Now this final assembly piece, this is where previously they had tried to sneak in that union requirement. In this version, that is dropped. There is no such stipulation, so good news for Tesla on that front. And then probably the most critical piece of all of this, I should have just started with this, but I assume people have already realized this, the manufacturer limit and the whole phase out thing, that has all been completely struck in this proposal. There is no more 200,000 vehicle cap. There is no cap at all for any individual manufacturer. The only caps here are on price, income, and then of course effective dates. So on price, this is based on the manufacturer's suggested retail price. I would assume that that would include vehicle options, so we're not just talking about a base price here. But those price thresholds for vans, sport utility vehicles, and pickup trucks, that'd be $80,000, and then for anything else, it'd be $55,000. In terms of how that gets classified, it just says that the Secretary, I assume Secretary of Transportation, would be prescribing regulations for how those classifications are determined. I would assume that that would follow the EPA, which does classify the Model Y as an SUV. So for the Model Y, that would fall well below that threshold without any options. If you add FSD, that would come in over, but you can always add that after purchase, and Tesla may find some other ways to get creative about those things. Might need to do a little bit of that with the Model 3, which right now the long-range version starts at $58,000, which would make that version ineligible. And the standard range version, since that uses a lithium iron phosphate pack, I'm not sure if that would qualify for either half of the battery components or battery minerals qualifications. So this would put Model Y in a really great spot, probably put Model 3 in a relatively tougher spot, which in and of itself kind of highlights some of the flaws here. I think these hard limits on pricing are pretty stupid. Makes things tough for manufacturers that have vehicles around those price points. Something that phases out would seem to make a lot more sense. For the Model S and X, obviously they would not be eligible at current prices, and the Cybertruck, that would be TBD. So you have price limits and then you have income limits. Those are based on your filing status. So a joint return, the limit there for modified adjusted gross income would be $300,000. Head of household would be $225,000, and then any other case, $150,000. Everyone will have their own opinion on that, but definitely will reduce eligibility and therefore spend on the credits. Probably worth noting though that that limit applies to whatever is lower between the current taxable year or the preceding taxable year. All right, so how about effective dates? This would be for vehicles placed in service after December 31st, 2022. As far as I can tell, there is no retroactivity, even if this were to be passed before that date. That same date is also listed for the elimination of the manufacturer limitation like we had talked about before. As for end dates, this is probably one of the most wild parts of this. There is no phase out written in here, and it says that the termination would be December 31st, 2032. So 10 years of possible $7,500 credits, though again, some of the requirements to earn those credits do scale up as the years go by. So this is potentially massive. It's really hard to overstate how significant this might be. I'm not even sure Congress really understands how significant this could be. I mean, certainly no guarantee that it sticks around that long anyway, but just Tesla alone, we could be talking tens of millions of vehicles, hundreds of billions of dollars worth of credits that, yeah, technically go to the consumer, but that really isn't how supply and demand works. While there are certainly plenty of changes that I would make to the structure just from a US perspective, not even a Tesla perspective, I do think of the proposals that we have seen, this one is on the more friendly end of the spectrum for Tesla. The plug-in hybrid stuff is a joke, but in terms of all electric vehicles, Tesla should be relatively well positioned to capitalize on these. Now, I've seen some people saying that, oh, maybe Tesla is getting cut out from the dealership angle here. That's not the case. There is a section here for transfer of credits. Big long section you can see, and this does talk about dealers, but it's all about the option that a taxpayer has to allow that credit to be transferred to a dealership, effectively then taking the credit at the point of sale. However, it does specify what is meant by a dealer, and it just says for the purposes of this subsection, basically the term dealer means a person licensed to engage in the sale of vehicles. Obviously, Tesla is allowed to do that in some states, and even if not, Tesla can still sell the vehicle in a different state. It's a federal credit, so I don't think there would be any issues for Tesla because of this. I've also seen questions on whether or not this is a refundable tax credit. The current structure is not, and I don't see anything in here that changes that. A refundable credit means you can offset more than your tax liability and actually get money back, versus a non-refundable credit would only credit up to the tax liability that you have. So if you didn't have $7,500 of tax liability, you wouldn't get the full credit. So I don't know how dealers are supposed to know these things or things like income limits ahead of time for that whole transfer of credit thing. Maybe some of that will be hashed out in later versions of this, but it's also very possible that I just don't understand what exactly they're saying for that process here. I've also seen some confusion stem from a portion called the transition rule. Basically, all that is doing is outlining that if a customer has a purchase agreement, but the in-service date of that vehicle doesn't happen until after this enactment, they can actually retroactively change the in-service date to be the day before the enactment just to get things under the old structure if they want. So that won't affect many people, but some people misreading that, so just wanted to make it clear what that was applying to. Very limited circumstances. There's also a clause in general in here that is worth noting, and that is a foreign entity concern clause. That would exclude vehicles from being eligible for credit if after 2024, any mineral in the battery is sourced from an area that is designated as a foreign entity of concern, or any battery component after 2023. Now, I looked this up to try to figure out what exactly these areas were. I'm not exactly sure. It looks like there's a 600-page document that outlines those specific areas. Looked on Wikipedia for areas in China. I don't think Tesla would have concerns here, but something to be aware of. All right, so I think that's everything as far as new vehicles go. I guess we didn't talk about fuel cell vehicles being included, but those are included. The used vehicle section, that was completely different. I didn't have time to do this whole puzzle piece with that section, but here is what I can gather for that. There is a proposed credit for so-called used clean vehicles. That credit would be the lesser of $4,000 or 30% of the sale price. The sale price must not exceed $25,000. I've seen a lot of people miss that. Kind of a weird stipulation. It must be sold by a dealer, which is defined by that same section we just read. So I'm not certain on that, but I think that means that it doesn't apply for a private sale. Anyway, the model year must be at least 2 years before the calendar year of acquisition. It must have a 7 kilowatt hour or larger battery, just like the new credit. Each buyer, or I think each taxpayer, can only claim the credit once every 3 years. And again, there are modified adjusted gross income limits. These are lower: $150,000 for joint filer, $112,500 for head of household, $75,000 for all others. There are also adjustments to commercial vehicles here. Again, didn't have time to put those puzzle pieces together, but from what I can gather, the credit is the lesser of $40,000, 30% of the total sale price, or the incremental difference in comparable non-qualified vehicles. So let's say there was a $50,000 vehicle and a comparable vehicle is $40,000, then you'd get a $10,000 credit. This would be for vehicles over 14,000 pounds. If it's a commercial vehicle lower than that, a $7,500 max would apply, and it must have a 15 kilowatt hour or larger battery, or 7 kilowatt hours, again below 14,000 pounds. So obviously for Tesla, this could be huge for the Tesla Semi. Could see very much a situation where Tesla could get that whole $40,000 credit, or rather the buyer could get that $40,000 credit. But yeah, that might come back to Tesla a little bit through Tesla's pricing. So again, a little bit less confident on any clauses that might cause some strangeness in the commercial vehicle sector, but that's what it looks like to me. Last piece on vehicles, and then really big news for Tesla Energy too, but this one less Tesla related for 2 and 3 wheel vehicles. That section in the current legislation was completely struck from this proposal, so I'm not sure if that then falls under the other categories or not. So it could mean that for these vehicles, they could potentially get a bigger credit than what they got before, maybe that full $7,500 credit. That'd be huge for a company like Arcimoto, for example, or there's a possibility that they then don't qualify, and I'm not sure which way to read it. So it could be pretty impactful. Hopefully we can figure out which of those is the case. And then for energy, we're going to rely on some reporting here from PV Magazine. They had a chance to go through some of that. I haven't for the energy side, but they note that the solar investment tax credit under this proposal would be extended out another 10 years out to 2032 at a 30% credit, then phasing down in 2033 and 2034, 26 and 22% respectively. That would be absolutely massive. That's already been extended out a couple of times, but not for such a significant length. And it does also say that it would apply to energy storage. PV Magazine says that that applies whether it's co-located or installed as a standalone energy storage. So they say this enables a retrofit of a battery to an already existing solar array while being able to take advantage of the credit. So all of these things would be very, very significant news for both Tesla Solar and Tesla Energy Storage. So again, all of this is subject to change. I think they were trying to get it into the Senate like next week or something. I'm not 100% certain on that. I'm sure there will be some changes here and there trying to get people's special interests in. But this is pretty extensively structured at this point. It's very different from when we had last seen a proposal. And from what it sounds like, this entire package seems to have a lot more legs than before. So we'll continue to monitor this very closely. Huge implications for Tesla, huge implications for the entire automotive industry, even worldwide, I would say, and the entire downstream supply chain. I think we've addressed most of how Tesla fits in. Probably the biggest remaining question is Tesla's battery minerals sourcing and how much of that comes from free trade zones. But I think on the components and the assembly stuff, Tesla's looking pretty good, except for maybe with that standard range lithium iron phosphate pack. So let me know what your comments are on this. Let me know if you have any questions, or let me know if you think something I missed. Hopefully not, but that will wrap it up for today. As always, thank you for listening. Make sure you're subscribed and signed up for notifications. Also find me on Twitter at Tesla Podcast, and we'll see you tomorrow for the Friday, July 29th episode of Tesla Daily. Thank you.